Yeah, so the stock to flow ratio is a ratio from the commodities market actually that tells you something about an asset's scarcity. It divides the stock, the reserves of a certain asset by the flow, the newly issued Bitcoins or gold, newly mined gold. And if you divide the stock by the flow, you get the stock to flow ratio. So that ratio was known for ages in the commodities market. What I did was connect that with the market value of, Bitcoin in the beginning, but later also the other assets like silver and diamonds and gold and real estate. And what you find that there is a perfect linear relationship in the logarithmic space. So that was quite shocking. And with that, you can actually predict the price of Bitcoin very roughly, I should say, but you can do it. And because we know the stock to flow ratio of Bitcoin, it's pre-programmed, and that's a very nice thing. And it's of course very bullish. At the moment, it predicts somewhere around $100,000 Bitcoin for the current halving cycle, which is 2020, 2024. So we're actually heading towards that. Yeah, it's that.
So when you think of the stock to flow ratio, one of the things that I'm fascinated by is it comes from the commodities market, but it's actually potentially more accurate when it comes to Bitcoin because we know with certainty and can prove the supply of both the outstanding supply and the daily incoming supply. Describe a little bit about why that certainty and that verifiability is so important to the accuracy of a model like this.
Yeah, so for example, with gold, we don't know how much gold is mined every year. We can make a forecast, but we don't know it precisely, and a lot of factors impact that supply, that mine supply of gold. And one of the factors impacting that is price, right? If the price of gold is high, then the miners will increase their production. And if the price of gold is low, they will decrease the production and the mining of gold. With Bitcoin, the whole production, the whole flow is pre-programmed. Every 10 minutes on average, right? Every 10 minutes there's a block, and in that block is a block subsidy with the new Bitcoins for the miner that found the hash of that block. So we know sort of that every 10 minutes and for the whole year how much Bitcoins there will be mined. Of course, we don't know it exactly because there is some variability in the 10-minute interval. Sometimes it lasts an hour. Sometimes you have like 3 blocks in 10 minutes. But on average, we know, and especially long term, we know what the stock to flow ratio will be, and thus what the price will be roughly.
So when you think about these halving cycles, obviously there's a supply shock, but how do you think about kind of the cyclical nature of this, right? Is there a point where you expect the model or ratio to be invalidated, either through external forces or people start to kind of price it in and front run it? Like, how do you think about the fact that we do know the supply and that helps for the accuracy of stock to flow, but at some point, does that become a negative?
Yeah, there's several aspects to that. Of course, from efficient market hypothesis, you would expect that this knowledge and the model would be priced in. So I actually, and most people with me, expected the halving, the May 2020 halving would be priced in already. So we would not see the actual price rise that we're seeing now. That is very much in line with the stock to flow model, because all the information is out there, the stock information, the flow, the stock to flow ratio, and the model. So it shouldn't follow the model as closely as it does today. On the other hand, there's a lot of people not believing the model, and the model, of course, hasn't proven itself. So maybe that sort of puts the efficient market hypothesis argument aside. But on the other hand, I think that the stock to flow model will break in the future, because one of the nice things about the stock to flow model, and especially the stock to flow cross asset model, the stock to flow X model, which also incorporates data from the gold market, diamond market, real estate market, and silver market. So other stores of value, if you will. If we look at that stock to flow X model, we can interpolate the data because gold has a higher stock-to-flow ratio than Bitcoin, and real estate has a higher stock-to-flow ratio. Gold is around 60, and real estate is around 100, where Bitcoin is 50, 55 right now. So we know we can, within the data set we have available with gold and real estate in there, with market values of 10 trillion for the gold market and 100 trillion for the real estate market, we can interpolate within the data set, and of course that ends, because if Bitcoin will have its next halving in 2024, the Bitcoin stock-to-flow ratio will jump to 100, which is which is approximately the same as real estate. But after next halving, where we jump to 200 stock-to-flow ratio for Bitcoin, we're out of the model data bounds, if you will, and then we have to extrapolate, which is what basically all the other models are doing. They're extrapolating into the future, which is very dangerous. And one of the big assets, big advantages of the stock-to-flow model, the stock-to-flow X model in particular, is that this interpolation can be done. So to be in short, I think the stock-to-flow model will end to be valid somewhere after next halving, when the stock-to-flow is above 100, because we cannot interpolate anymore. And of course, that means probably that the dollar, the denominator in that model, will end to play a big role, or something. Of course, it doesn't say that Bitcoin will die or something. It's it's just a model will not be very accurate after that.
For sure. And one of the things that I appreciate about you is not only can you look at something like the stock-to-flow model and talk about kind of these cyclical natures of the halvings, but also you've got a very good understanding of market structures and various things that happen on the exchanges. You had a tweet recently talking about these sell walls as kind of pure scare tactics, and we've pulled up the tweet here. Describe a little bit more about what goes on in these order books with these sell walls and how folks are using them as a scare tactic.
Yeah, what most people maybe don't know is my background is in institutional investment, and I've been in institutional investor roles my entire life. So I started at a dealing room in FX trading, then went to banking balance sheets and insurance balance sheets, and lately my latest job was managing a pension balance sheet with the team, and that balance sheet was $100 billion US dollars approximately. So I spent my life chasing those charts that you have in front there, and chasing those sell walls and buy walls. And what I noticed was that most people are sort of scared by those big walls, those big sell walls in this case, in that chart. And of course, most of the time, not all the time, but most of the time, these sell walls are just there to scare people in not buying or even selling, and plus because they signal, don't come here where there's at the price level where the sell wall is, because we will sell and we will keep the price under this level. But in fact, what you see in real life 9 in 10 times, you see that as the price approaches the sell wall gets cancelled and moved further away. So in this case, the sell wall will be moved at a higher price. So it's just scare tactics, and I thought it was a good thing to put that in the tweet for other people to know.